1, 2, 3, 4. So here we go with Chapter 11, going over stockholders' equity. So this first question, we've got the New York Yankees issues $1 million common stock shares for $5 per share. Par value is $1. If these were the only shares, what will the balance sheet? Okay, whatever. Let's make the journal entry first. So we're issuing $1 million. 1 million shares of common stock for $5 each. So we're receiving cash, debit cash, 1 million shares, $5 each. That is $5 million of cash. And we're issuing common stock, so we will credit common stock. But now this is, we're only recording the common stock at its par. So the par value is just a legal value that companies have to express. There's no real significance for it in the accounting world, but we have to show the par value. So the par value is $1 each for the common stock. $1 each for 1 million shares is $1 million for common stock. And then the remainder is put into this thing called additional paid in capital for common stock, which is $4 million. So these two accounts are both equity accounts. They're pretty much the same thing, except we just separate them out because we have to show what common stock is at par value. But combined, they're both common stock. So the balance sheet would show something like common stock was at $1 million. Right below it, paid in capital is at $4 million. And then we would add that up to be $5 million as our total paid in capital. Something like that. So number 2, we've got a company that has 500 shares issued, 100,000 in treasury stock, and they're paying a cash dividend. What's the total amount of the cash dividend? So a cash dividend is only paid to the shares that are outstanding. So if we go over the 3 words that we need to know. So the 3 words that we have to go over are authorized, issued, and outstanding. Authorized is the maximum amount of shares that a company can ever issue. So let's say it's 15. The company made a decision and said the maximum amount of shares we can ever issue is 15. Issued is how many are actually issued right now. So there could be 5,000, there could be 10,000. It just has to be less than the amount authorized. We can never go above what is authorized. Outstanding is how many of the shares issued are still owned by the public. So let's say 4,000 shares are outstanding. That would mean 4,000 shares are in the public's hands and 1,000 shares were bought back by the company as treasury stock. So the treasury shares would be 1,000 in this example. So the amount outstanding plus the treasury should equal the amount issued. So if we go back to this example, we've got 500 shares issued and 100 in treasury. That would mean the outstanding is 400,000 shares. We're only paying a dividend on the outstanding shares. So if there's 400,000 shares and we declare a 50-cent cash dividend, that means the cash dividend is going to be $200,000. Okay, assume that we have 50,000 shares of common stock issued and outstanding, so there's no treasury stock. The par value on the stock is $6. What would happen for a 3-for-1 stock split to the number of shares and par value? A stock split, this is saying that for you're going to get 3 shares for every 1 share that you have. So an example of this could be like, imagine or think of every share as a piece of paper. And shares are pieces of paper, so that's a pretty easy comparison. When a 3-for-1 stock split happens, it's pretty much saying, okay, rip this up into 3 pieces, and now you have 3 shares of stock. You originally had 1 share, but now you have 3 shares. So if we have 50,000 shares outstanding, that would mean that the 50,000 is being multiplied by 3. There are now 150 shares after the stock split. And the par value of 6 will be cut into thirds, so we're ending with a par value of 2. So the easy math is to multiply the shares by 3 and divide the par value by 3. That's how you get those numbers. Which is true of a stock dividend. Okay, stock dividends involve a payment of cash. That's wrong. A stock dividend involves a payment of stock. A cash dividend involves a payment of cash. Stock dividends, so A is wrong. Stock dividends cause the number of shares issued to decrease. That's incorrect, because a stock dividend, we're giving out more stock, which would increase the amount of shares issued. So B is wrong, so then C is right. The effect of stock dividends on total stockholders' equity is 0. That is correct. We are increasing, whenever we have a stock dividend, we are increasing common stock and paid-in capital, and we are decreasing retained earnings by the same amount. So we're increasing common stock and paid-in capital, which is an equity account, and we're decreasing retained earnings, which is also an equity account. So the net change on stockholders' equity is 0. Okay, we've got both common stock shareholders and preferred shareholders. The company currently has issued an outstanding 1,000 shares of 5%, $100 par value preferred stock. Excuse me. The company declares and pays $20,000 in cash dividends. How much will go to common shareholders? We're assuming that there are 100,000 or 10,000 dividends in arrears. So we've got some preferred stock. Preferred stock, in this case, is guaranteed a 5% dividend every year. Let's see, there's no dates. So since preferred stock is guaranteed a dividend every year, and sometimes a company can't pay the dividend every year, so those dividends that we owe the preferred shareholders start stacking up. That's what this dividend in arrears means. We owed them some dividends from the past, but we just never paid them. So now that we have some money to pay out a dividend, we have to pay back these dividend in arrears for the preferred shareholders. Now, when I say that we owe the preferred shareholders dividends, you might think of it as a liability, and it kind of is. It feels like a liability, but in accounting, we don't record it as a dividend payable. We never set it up as a liability, but it does feel like a liability. So we owe $10,000 from previous dividends, and then we owe them a dividend for this year. And the way we calculate that is we take 5% of the par value times the number of shares, 1,000. And that should be 5,000, I believe. $5,000. For past year's dividends, we owe them $10,000. For this year's dividends, we owe them $15,000. So that's a total of $15,000 in dividends that the preferred shareholders will get. So the preferred will get a $15,000 dividend, and then common stock shareholders will get whatever is remaining, which is $5,000. And I got $5,000 because we're declaring a $20,000 dividend. 15 goes to preferred, 5 goes to common. An architecture company declares and distributes a 10% stock dividend on its a 10% stock dividend on its common stock shares. We got 60,000 shares before the stock dividend. If we own 5% of the company throughout the declaration and distribution, how many shares will you have after the stock dividend? So this question is kind of confusing. So it's saying that we're a shareholder. We have 5% of this company. So in other words, there's 60,000 shares issued, and we own 5% of those shares. So 60,000 times 5% is $3,000 or 3,000 shares. We own 3,000 shares. Now they're declaring a 10% stock dividend, which means that we're going to take the amount of shares that we own times 10%. That gives us 300 shares. So we owned 3,000 shares originally, and then we got an additional 300 shares. After the stock dividend, we're left with 3,300 shares in the company. And I believe that is chapter 10.